Our next video lecture will focus on how to record business transaction using what's known as the general journal, key accounts, as well as the general ledger. Okay? Debit and credit procedures. Now, if you notice that in our first video lecture with the account equation, there was always at least two accounts involved in recording each business transaction. When it comes to what we call debits and credits, it's the same concept, meaning that for every transaction, at least one account is going to be debited and at least one account is going to be credited. Now, in your mind, you have a definition of the term debit and credit. Unless that came from your accounting classes previously, get rid of that definition because otherwise it's going to confuse you. So I'm going to explain to you in simple terms what the terms debit and credit actually mean. You ready? Let's go. Every account, so what we have here is a little device known as a T account. See, it's shaped like a T, all right? So a T account is used to record a company's different types of business transactions. Every account title has its own separate T account, meaning under assets, you have a cash T account, one for supplies, for equipment, prepaid insurance, automobiles, etc. Every asset account has its own separate T account. The same is true for your liability accounts, retained earnings account, common stock, etc. Every account title has its own separate T account. Okay? Now, there are two sides to the T account. There is the left-hand side of the T account, and there is the right-hand side of the T account. Left-hand side of the T account, right-hand side of the T account. The left-hand side of the T account is known as the debit side. For every account title, the left-hand side of the T account is known as the debit side. So if you are asked to debit a transaction, that simply means record it on the left-hand side of a T account. Every T account also has a right-hand side. The right-hand side is known as the credit side of the T account. So in accounting, the term credit means right-hand side of the T account. So if you're asked to credit a transaction, it simply means to record the transaction on the right-hand side of the T account. Now, there are rules to this debit and credit. There's rules to this process. What does that mean? It means that there are certain accounts that will increase on the debit side, while other accounts increase on the credit side. They're known as the rules of debits and credit. Now, why is it the case? Because accounting is a rule-based profession. I did not make up these rules, people, but as an accountant, we have to follow the rules that have been set forth by FASB, which is the organization that developed the General Accepted Accounting Principles. Okay? Your job is to just follow these rules. If you do that, you will be okay. So let me give you some techniques, some tips on learning the rules of debits and credits. Focus on the positive, meaning what side of the account will make the account increase. If you know the account's increase side, then the account must decrease on the opposite side of the T account. For example, assets increase on the debit side of the T account. Liability accounts increase on the credit side of the T account. Common stock increase on the credit side, retained earnings credit side, revenue credit side, expenses debit side, and dividends debit side. Okay? So I'm going to give you a little mnemonic to remember for these rules. First, let's focus on the accounts that always increase on the debit side. You ready? Write this down. The mnemonic is called DADE. D-A-D-E. DADE. D-A-D-E. DADE shows the types of accounts that will always increase on the debit side. So the first D, of course, stands for debit. The A stands for asset. The D stands for dividends. And the E stands for expenses. DADE. D-A-D-E. Those are the accounts that will always increase on the debit side. So if I know that the account increased on the debit side, then those same accounts must always decrease on the credit side. But once again, focus on the positive. What side of the account will make the account increase? If I know the account's increase side, it must decrease on the opposite side of the T account. Our next mnemonic, write this one down. It is CCLRR. CCLRR, which stands for C clear. Yes, I made that up, but as a professor, I'm licensed to do so. So again, CCLRR, our next mnemonic, shows the type of account that will always increase on the credit side. You have the second C, common stock, the L, liabilities, the R, retained earnings, and the other R would be revenue. So your liability accounts, common stock, retained earnings, and revenue accounts will always increase on the credit side. Once again, focus on the increased side. What side of the account will make the account increase? If I know the account's increase side, they must decrease on the opposite side. For every transaction, it must balance, meaning the total amount debited must always equal the total amount that was credited. So we have a form known as the general journal. The journal is a form we're going to use to record a company's different types of business transactions. The journal is listed in chronological order or date order. So you'll list your transaction as they occurred during the accounting period. It is a complete listing of all of our business transactions that have taken place over a specified period of time. And as mentioned, they're listed in chronological or a date order. It is used to help prevent errors or locate errors because, again, for every journal entry, the total amount debited must equal the total amount that's going to be credited. So let's practice using the journals to record some business transactions. On October 1st, Sierra issued common stock in exchange for $10,000 in cash. Okay? So again, when you think about that transaction, you want to ask yourself which accounts are involved. The accounts will be common stock and cash. All right? Then ask yourself, are the accounts increasing or decreasing? In this case, both cash and common stock are going to increase. Then ask yourself, what are the account classification? So cash is an asset account. Common stock falls up under stockholders' equity. Assets increase on the debit side. Common stock is going to increase on the credit side. So when using the journal, another word I tell you about, you put the date of the transaction first. Whatever account you're going to debit, that account title goes first in the journal. So cash is written first. Excuse me. Record the amount in the debit column. You're then going to indent, show the account to be shown on the credit side, being common stock, and record that amount in the credit column. Every journal entry has to be in balance, meaning the total amount debited must always equal the total amount that was credited. Next, we borrowed $5,000 by signing a promissory note. We know the accounts involved were cash and notes payable. Once again, cash is an asset. Notes payable is a liability account. Both counts are increasing. Assets increase on the debit side. Liability counts increase on the credit side. So in our journal, we'll put the cash account first because whatever account you want to debit, the account goes first in the journal. Record the amount in the debit column, followed by the notes payable account, and record the amount in the credit column. Notice that the transaction has to balance. The total amount debited must equal the total amount shown on the credit side. Want some more? Got some more for you. We purchased equipment for $5,000. So the first step is always to analyze the transaction to determine which accounts are involved. It will involve cash and equipment, which are both asset accounts. The equipment account is going to increase. Cash being an asset, assets increase on the debit side. Equipment and asset, assets increase on the debit side. Cash is decreasing. Cash is an asset. Asset account decrease on the credit side. So in the journal, the account we're going to debit goes first. That would be the equipment account. The amount is going to be $5,000. We'll then write the second account titled cash and put the amount of $5,000 on the credit side. Again, every journal entry has to balance. The total amount debited must equal the total amount you're going to credit. And in the journal, this just shows so for all of those transactions listed in the general journal, the journal keeps a chronological listing of all of our business transactions that have taken place over a specified period of time. So make sure you practice using the journal to record your different types of business transaction. We have one more lecture, chapter 3, that focuses on how to post to what's known as the general ledger and how to prepare what's known as a trial balance.